What if the moment everyone feels like giving up on something is actually the moment the smartest opportunity shows up? Right now, across financial forums, social media feeds, and even private investor groups, there is a growing feeling that Bitcoin may have had its run. The enthusiasm that once filled comment sections and news headlines has gone quiet. And some people are wondering whether this silence is the beginning of the end, or the calm before something much bigger. Before you make any decisions, before you panic, before you sell or stay on the sidelines, consider this. Throughout economic history, the periods that looked the most discouraging to the average person were often the very windows that long-term thinkers quietly used to position themselves. Is that what is happening right now with Bitcoin? Could this period of low sentiment and compressed prices actually be one of the most significant accumulation windows in a decade? We are not here to tell you what to do with your money. We are here to explore the ideas, the questions, and the frameworks that might help you think more clearly about what is unfolding. This video is going to be long. It is going to be thorough. And if you stay until the end, you will have a framework for thinking about digital assets that most people simply never develop. If you find value in content like this, consider hitting the like button and subscribing. It genuinely helps this channel reach more people who are trying to make sense of their financial future. Now, let us begin. To understand where we might be going, it helps to understand where we are right now. And the honest answer is, sentiment is negative. Not mildly negative. Not cautiously skeptical. For many people who have been watching Bitcoin closely, the mood right now is one of genuine doubt. And that doubt is coming from a very specific place. In previous downturns, there was always a clear villain. There was a catastrophic exchange collapse. There was widespread fraud uncovered at a major institution. There was a specific and identifiable reason that prices dropped. And because the reason was clear, it was also easier to understand that once that problem was removed, the underlying value of Bitcoin itself had not changed. But what makes this particular moment feel different for a lot of observers is that there is no single obvious cause. Prices have underperformed relative to some expectations. Momentum that some had anticipated has not materialized. And perhaps most unsettling, a new technology category has emerged and captured the collective imagination of investors in a way that may have temporarily redirected attention away from Bitcoin. We are talking, of course, about artificial intelligence. AI has become the defining investment story of this era. And when a powerful new narrative takes hold in financial markets, it has a way of pulling energy, attention, and capital in its direction. So one question worth sitting with is this. Does the rise of artificial intelligence compete with Bitcoin, or could it actually be complementary to it over a longer time horizon? We will come back to that question. But for now, let us ask something more foundational. Drop a comment below. Are you currently holding Bitcoin, watching from the sidelines, or somewhere in between? Your answer might surprise you when you revisit it in 12 months. Here is a question that sounds simple but cuts very deep. What is Bitcoin actually for? If you have been following Bitcoin primarily as a price chart, as a number that goes up or down, then periods like this are psychologically brutal. Because when the number is not going up, the entire case for holding it seems to evaporate. But what if price is not the primary value proposition of Bitcoin? What if price is merely one symptom of something far more fundamental? Consider this idea. Throughout recorded history, societies have struggled with one core financial problem. Who gets to control money, and how can that control be abused? When a government needs to fund a war, it can print currency. When a financial institution becomes overextended, it can be quietly bailed out. When an individual is deemed politically inconvenient, their accounts can be frozen. These are not hypothetical scenarios. They are events that have occurred, repeatedly, across different countries and different economic systems. Bitcoin was designed as a response to that problem. It was built to be money that no single authority can inflate, seize, or censor. The supply is fixed. The network is distributed. And access does not depend on permission from any institution. Now, you might agree with that vision or you might not. You might think the existing financial system is trustworthy enough that this alternative is unnecessary. That is a completely valid perspective to hold. But here is the question worth asking. Has anything about that original value proposition changed? Has anyone found a way to inflate the Bitcoin supply beyond its predetermined limit? Has any government successfully shut the network down? Has self-custody of Bitcoin become impossible? If the answer to those questions is no, then at minimum, the foundation of what Bitcoin was built to be appears to remain intact. Whether that foundation justifies any particular price is a separate question. But the concept itself does not appear to have been broken. This is what some long-term holders mean when they talk about going back to first principles during difficult markets. They are asking themselves, did the thing I believed in fundamentally change? Or did only the price change? Those are very different questions. And the answer to each one may lead you to very different conclusions. One of the concepts that comes up again and again when serious analysts discuss Bitcoin is the idea of absolute digital scarcity. It sounds technical, but the implications are genuinely worth understanding. Throughout human history, value has been linked to scarcity. Gold became a store of value partly because it is genuinely difficult to extract from the earth. Land holds value partly because there is a finite amount of it. Rare art commands high prices partly because only one original exists. But here is the complication. Every form of scarcity that existed before Bitcoin could theoretically be overcome. Gold can be mined in greater quantities if the technology improves or if new deposits are discovered. Even the supply of physical gold is not perfectly fixed. Land is finite, but the rules around land use, taxation, and ownership are controlled by governments. Art can be replicated, forged, or devalued by the emergence of new movements. Bitcoin, by contrast, is often described as the first instance of absolute digital scarcity in history. The total number of Bitcoin that will ever exist is embedded in the code. It cannot be changed without the agreement of the entire network. And the structure of that network makes such agreement essentially impossible in practice. Now here is a thought experiment. If you go back and look at commodity markets, you can find examples of dramatic price movements in materials that are genuinely abundant. Raw industrial metals, for instance, have experienced price surges of hundreds of % within very short time windows. Not because the world ran out of them, but simply because in a specific moment, demand exceeded the available supply flowing through the market. The question some analysts are beginning to ask is this. What happens when something with a genuinely fixed and verifiable supply encounters expanding global demand? Not just current demand, but the demand that might emerge as billions more people gain access to digital financial systems over the next decade? Is that scenario guaranteed? Absolutely not. Nothing in investing is guaranteed. But is it a scenario worth thinking seriously about? That is something each person will have to decide for themselves. Here is something I am curious about. Have you ever held any asset primarily as a long-term store of value rather than a short-term trade? Comment below with the word store if you have. I read every single comment. One of the most interesting dynamics in financial markets is what some researchers call narrative-driven investing. The idea is simple. Prices do not only move because of underlying fundamentals. They also move because of the stories that circulate about an asset. And right now, one honest observation is that Bitcoin has a narrative problem. Not because the fundamentals have deteriorated, but because the recent story has felt messy and complicated. Exchange-traded fund approvals, corporate treasury purchases, government-level discussions of strategic reserves. These are all developments that, on the surface, might sound extraordinarily positive. And yet, the price has not responded the way many anticipated. Why might that be? One possibility worth considering is that markets often price in anticipated events before they happen. If sophisticated investors believed for months that institutional adoption was coming, they may have already positioned for that outcome. By the time the news became public, the buying had already occurred. And the price, rather than surging, consolidated or even declined. This is sometimes called by the rumor, sell the news. And it creates a frustrating paradox where good news appears to produce disappointing price action. But here is what tends to happen on the other side of that dynamic. Eventually, a price moves past a meaningful threshold. A previous high is broken. And suddenly, the narrative machine kicks back into gear. Journalists look for explanations. Investors look for reasons. And a new round of attention and capital begins to flow toward the asset. Could that moment be approaching for Bitcoin? Could the next significant price breakout create a new narrative so compelling that it draws in a wave of participants who have been sitting on the sidelines? There is no way to know when that breakout might occur, or even whether it will occur. But the historical pattern of how narratives emerge, fade, and re-emerge in financial markets is something worth understanding if you plan to make long-term decisions. If you are finding this content valuable, now is a great time to tap the subscribe button. Every subscriber helps this channel stay independent and focused on education rather than hype. Here is a concept that deserves more attention than it typically gets. There is a significant difference between owning Bitcoin directly and owning financial instruments that are linked to Bitcoin. In recent years, it has become possible for investors to gain exposure to Bitcoin through exchange-traded funds, through corporate treasury vehicles where companies hold large amounts of Bitcoin on their balance sheets, and through other financial products that wrap Bitcoin in familiar packaging. For many people, these instruments offer genuine benefits. They are accessible through conventional brokerage accounts. They may fit more easily within existing tax and reporting structures. And they lower the technical barrier of entry for investors who are not comfortable managing digital wallets and private keys. But it is worth asking, what do you actually own when you hold a Bitcoin proxy? You own a financial claim. You own a piece of a fund, or a share in a company, or a contractual right. You do not hold the underlying asset directly. And that distinction carries with it a set of risks that are different from the risks of holding Bitcoin itself. The fund can have operational issues. The company can make poor decisions with its treasury. The custodian can face regulatory challenges. None of these risks are unique to Bitcoin proxy products, of course. They apply to virtually every financial product that exists. But the point is this. Bitcoin was designed specifically to allow individuals to hold a financial asset without depending on any third party to honor a promise. When you hold Bitcoin through a proxy, you reintroduce exactly the counterparty risk that Bitcoin was designed to eliminate. This does not mean proxy instruments are bad. For some investors, in some situations, they may be entirely appropriate. But it does mean that proxy ownership is a fundamentally different thing from direct ownership. And in moments of market stress, understanding that difference could matter quite a lot. Comment below. Do you currently hold any assets through funds or other wrapper products? No need to specify what. Just curious how many in this community think about the proxy versus direct ownership question. Let us talk about something that comes up repeatedly among long-term Bitcoin holders. The concept of self-custody. Self-custody simply means holding your Bitcoin yourself, in a wallet that you control, rather than leaving it on an exchange or in a third-party account. Why does this matter? Because exchanges are companies. Companies can fail, be hacked, face regulatory shutdown, or in rare cases, engage in conduct that puts customer funds at risk. We have seen examples of all of these scenarios play out over the past decade in the digital asset space. When you hold Bitcoin in a self-custody wallet, those risks effectively disappear. Your Bitcoin is on the network itself. It cannot be frozen by the exchange. It cannot be lost because the exchange had bad risk management. It cannot be seized without access to your private keys. Self-custody does introduce its own responsibilities. You must secure your private keys. You must understand how to use the wallet software. You must have a backup strategy in case you lose access. For some people, these responsibilities feel manageable. For others, they feel overwhelming. The key insight is this. In periods of market uncertainty, knowing that you directly and verifiably hold what you own can provide a form of peace of mind that has genuine value beyond just the financial aspect. When you can independently verify your holdings on the network without relying on a third party to confirm them, you have a degree of certainty that traditional financial accounts simply cannot provide. Is self-custody right for everyone? Probably not. It requires a level of technical comfort and personal responsibility that not everyone wants to take on. But it is worth understanding that the option exists, and understanding why so many serious long-term holders consider it an important part of their strategy. Here is a question that rarely gets asked clearly in financial content. What is the difference between risk and volatility? In conventional investing, volatility is often used as a proxy for risk. If an asset moves up and down dramatically, it is considered risky. If it moves predictably and gradually, it is considered safe. But some financial thinkers would argue that this is a flawed definition of risk. True risk, in their view, is the probability of permanent loss of value or purchasing power. And by that definition, volatility and risk are not the same thing at all. Consider an asset that fluctuates wildly in price over a 10-year period, but ends that period significantly higher in real purchasing power terms. Was holding that asset risky? By the volatility definition, yes. By the permanent loss definition, perhaps not. Now consider an asset that barely fluctuates in nominal terms, but whose purchasing power erodes slowly and consistently over decades due to inflation. By the volatility definition, it looks safe. By the permanent loss definition, it might actually be quite risky. Cash sitting in a low-interest account, in a world where prices are rising, is one possible example of this second category. The number in your account does not move much. But what that number can actually buy you might be quietly shrinking. This framework does not automatically make Bitcoin a good investment. It does not answer the question of how Bitcoin will perform over any given time horizon. But it might change the question you are asking. Instead of asking whether Bitcoin is volatile, you might instead ask whether the long-term trajectory of Bitcoin's purchasing power is likely to be positive, negative, or uncertain. And you might ask the same question about every other asset class in your portfolio, including ones that feel much safer because their price does not change very much. We have put together a free financial planning toolkit that can help you map out your own wealth allocation across different asset classes with these kinds of long-term questions in mind. If you want access to that toolkit, drop the word toolkit in the comments below and we will send you the link directly. It would be incomplete to talk about Bitcoin in isolation without considering what the alternatives look like. Because one of the most compelling arguments for Bitcoin is not necessarily about Bitcoin itself. It is about the weaknesses of everything else. Property has been the cornerstone of wealth-building strategy for millions of families across the United States, the United Kingdom, Canada, Australia, and much of Europe. For many decades, this strategy worked remarkably well. Home values appreciated. Leverage amplified those gains. Families built generational wealth through real estate. But there is a question worth sitting with. Is the property market of the next 30 years likely to look like the property market of the last 30 years? Interest rates have moved significantly in recent years. Loan-to-value ratios at many lenders remain elevated. In many major metropolitan areas, the ratio of median home price to median income has stretched to levels that previous generations would have considered extraordinary. It is worth remembering that property does not always go up. Historical data from various countries shows periods of significant and extended property price declines, sometimes lasting a decade or longer. The common perception that property is a one-way upward trajectory is arguably a product of survivorship bias in the data most people are shown. Similarly, bond markets and conventional savings instruments in many countries are offering real returns that, once adjusted for inflation, may be neutral or even negative depending on the measurement period. The stock market has been a strong performer over long historical periods. But it is not without concentration risk, currency risk, and geopolitical risk that may be more significant in the current environment than in previous decades. None of this is to suggest that property, bonds, or equities are bad investments. Diversification and context matter enormously. The point is simply this. When you evaluate any asset, including Bitcoin, it is worth evaluating it in comparison to the realistic alternatives rather than against an idealized version of what other asset classes might offer. When you look at the landscape that way, the conversation about Bitcoin as a component of a well-considered portfolio looks somewhat different than it does when Bitcoin is compared only to its own all-time high. There is one principle that appears repeatedly in long-term investing literature across virtually every asset class. The cost of missing significant price moves can outweigh the cost of holding through volatility. This is well documented in equity markets, where studies have repeatedly shown that a significant portion of long-term returns is concentrated in a small number of trading days. An investor who missed only the top 10 or 20 performing days over a multi-decade period would have seen their total returns reduced dramatically compared to someone who simply held through all conditions. Could a similar dynamic apply to Bitcoin? It seems possible. If the supply is genuinely fixed and global adoption continues to grow over decades, even at an uncertain pace, then the moments of most significant price appreciation may arrive compressed and rapidly. An investor who holds through the quiet and uncertain periods would capture those moments. An investor who exits during periods of negative sentiment might not. This is not an argument that Bitcoin will definitely appreciate. It is an argument that if it does appreciate significantly, the pattern of that appreciation may look very different from a gradual, predictable upward trend. It may look like long stretches of frustration punctuated by periods of rapid and dramatic movement. If that is the nature of the asset, then the psychological difficulty of holding through the frustrating stretches may be precisely the feature that creates the opportunity. Because the investors who cannot tolerate the uncertainty are the ones who exit. And the ones who exit are the ones who will not be holding when the movement occurs. Whether the current moment is one of those accumulation windows, whether we are close to a significant inflection point or years away from one, is genuinely unknowable. Markets are complex systems. Anyone who tells you with certainty what Bitcoin will do and when deserves healthy skepticism. But the framework of thinking about patience, about the gap between price and value, about the nature of adoption curves for genuinely new technologies, is a framework that may serve you well regardless of which specific assets you choose to hold. If you have made it to this point in the video, you are clearly someone who takes your financial education seriously. And that alone puts you in a better position than the majority of people who make financial decisions based on headlines and emotion. Let us quickly recap the key questions we explored today. First, is the underlying value proposition of Bitcoin intact, even when sentiment and price are negative? That is a question only you can answer for yourself by understanding what you own and why you own it. Second, is absolute digital scarcity a genuinely new phenomenon, and if so, what might that mean for price dynamics over long-time horizons? The answer is uncertain. But the question is worth taking seriously. Third, is the current environment, with its compressed sentiment and sideways price action, a warning sign or an opportunity window? That depends entirely on your time horizon, your risk tolerance, and your assessment of the alternatives. Fourth, are conventional assets as safe as they feel? Or is the perceived safety of property, cash, and bonds masking risks that are simply less visible than the visible volatility of digital assets? And fifth, is the ability to hold through uncertainty the primary determinant of whether a long-term investor captures the potential value of an asset like Bitcoin? History in other asset classes suggests that patience is consistently undervalued. We cannot tell you what to do with these questions. What we can tell you is that asking them carefully, and revisiting them regularly, is more likely to serve your long-term financial well-being than making decisions based on the mood of any given week. Remember, this video is educational only. Nothing here is financial advice. Please consult a licensed financial advisor before making any investment decisions. If you want to go deeper and build your own wealth strategy, we have created a comprehensive financial planning toolkit with scenario models, allocation frameworks, and sustainable investing guides. Just drop the word toolkit in the comments below and we will send you the direct link. And if you found value in this video, please like and subscribe. It is the single most effective way to support independent financial education content like this. This is Green Planet Digital. Build wealth. Tread lighter. Live freer. We will see you in the next one.